What is a win for Chairman Powell tomorrow? Joining us now is Gershon Diston, founder of AllianceBernstein, and Jim Bianco of Bianco Research. Hey, Jim, what is a win for the chairman tomorrow? Is there one?
Unchanged markets. I think he's already telegraphed or forward guided that they're going to raise 50 basis points. They've already told us in the minutes that we're going to get quantitative tightening to the tune of $95 billion a month, and they'll put a little bit more detail on it. But I think a win is he says all of that, and the markets have very little reaction.
The call from Bank of America and Mark Cabana, and we caught up with him a little bit earlier this morning. This is what he had to say. It'll be hard for the Fed to out-hawk the market. A non-committal Powell on 75 basis points and that rate hike in June risk slightly dovish market outcomes. Can I come to you on that, Gershon? Does he have to validate what is priced in this market right now? Is that a goal of this chairman tomorrow?
I think this has been one of the most telegraphed meetings that we've seen. It's clear. He's been very clear, wants to get ahead of this, already behind the curve. The very fact that they're they're going to go 50 tomorrow and considering 75 the next time means they're behind the curve. I think what he's going to have to sound very hawkish. Hope the market is prepared for that. And is basically going to say he's going to do whatever it takes, whether it's going 75 at a clip, whether that's going beyond neutral. I don't think market participants should be surprised by that, but of course, who knows how markets are going to react.
Well, let's talk about later this summer, because I think later this summer is more interesting. We get a CPI print on May 11th, Jim, get another one on June 10th. Then we get this Fed meeting on June 15th, which has forecasts as well. And I think we're all trying to work out how this Federal Reserve will adapt, respond to inflation as you start to see that glide path lower. That's that peak, mechanical peak in CPI year over year. How do you think they respond to that?
Oh, I think that the mechanical peak in inflation is largely expected, and that's not going to be a market-moving event. It's going to be indications of how fast the descent is going to be. And I also think the other thing to watch for what the Fed is going to be talking about, not just tomorrow, but going forward, is the employment situation. Jay Powell made some comments a couple of weeks ago about the employment market being unsustainably hot, which is code for I can raise rates a lot and not cause unemployment, which spooked markets because the belief is if he gets too aggressive with rate hikes, he might create unemployment. But if he believes he won't create unemployment, then he can continue to move forward. So I don't think that the inflation numbers are going to come down fast enough in the next 30 or 60 or 90 days to knock the Fed off their path. So it's really going to come down to the Fed's belief on the employment situation. How much can they hike without creating unemployment?
This is something that Senator Downs-Gann Griffin touched on as well. Take a listen to what Ken had to say to us.
If the inflation is transitory, if we are heading towards a 4% rate by the end of the year, he has a lot more room to maneuver rates in 2023. If inflation doesn't break soon here, he's going to have to hit the brakes pretty hard. That will put us into a recession.
Gershon, is that the dynamic that you're laser focused on too?
I just think, John, that we're not going to see CPI prints that we're all comfortable with till sometime in 2023. Like we have to remember here, this is not purely a demand problem. The Fed's tools are designed to deal with the demand side. This is a supply side issue also. And if we don't see some of the bottlenecks in the supply chain kind of work themselves out, now that's a base case for everyone, but if we don't see that, then in order to really get inflation under control, we're going to have to see the Fed go well beyond neutral. 2.5%, 3% is not going to do it. And that's a risk to markets and something we need to pay attention to. But this idea that we're going to all of a sudden be comfortable come June with CPI prints where they're likely to print, I think that's just very, very unlikely.
The dilemma for a lot of people, Jim, is that they get more uncomfortable as the year progresses, that actually this Fed faces downside risk to growth and prolonged inflation simultaneously at the same time year end. Jim, given the choice between curtailing inflation and supporting growth, have you got an idea on what they choose?
Oh, I think the Fed's priority right now is inflation. And I think that this is still a struggle for a lot of people to get their head around. As of yesterday, the S&P had corrected 15%, the NASDAQ had corrected 20%, and we printed a negative first quarter GDP. That was enough in 2018 to get the Powell pivot. We're not even close to thinking about something like a Powell pivot right now. So this Fed is going to continue to move more and more as we go forward. And the idea that the Fed moves until they break things might actually turn around to how many things do they have to break before they decide that they're going to back off on the rate hikes. And we're not close yet. I think they're going to keep going as we move forward.
Well, they're not doing it alone. The RBA joined them overnight. Mike McKee, a ton of Fed decisions this week. Australia behind us, the Fed, and the Bank of England in front of us.
Absolutely. And you asked at the top of the show whether we could get to a 3% handle on yields. We already got there if you live in Australia. The benchmark 3-year goes over 3% as the governor of the RBA, Philip Lowe, delivers a surprise 25 basis point increase in interest rates there. Nobody called that one. And you can see the reaction. Now, here's what's interesting. You can see how the 3-year yield, their benchmark, was above the base rate for the RBA back in the late 2010s. But look at the spread now. Look at the difference now. The market's way ahead of the RBA in thinking of where rates are going to go. Now, Lowe did promise they would do more. So that takes us to the Fed. How much more are they going to do, as Jim Bianco was just talking about? I mean, we get 50 basis points. That's what's expected at the meeting tomorrow. First time since 2000. But what does the chairman say about what happens next? What does Chairman Powell say about where they stop? How high do they go? Markets, are almost pricing in a 75 basis point move for June. That'll be affected by what Powell says tomorrow. But the markets are getting more and more and more hawkish. Are they going to drag the Fed along with them? And then you pop over the pond to the Bank of England on Thursday. They're expected to raise rates. They're leading the way. They've been higher than everybody else. Expected to go another 25 basis points up to 1%, which would be the highest in 13 years, and discuss selling some of their gilt holdings. The Fed's not talking about that yet, but the Bank of England is going to be, if they get to this 1% level, at the level at which they said it would be appropriate to start talking about selling some QT of their gilt holdings, and we'll see if that happens. We get the information much more quickly from the BOE than the Fed in terms of minutes.
Mike McKee, thank you. Looking forward to that too. Interesting that over the last few months, what we have seen is, yes, rate hikes from the Bank of England, but a pound sterling cable that has actually got weaker. Sterling weaker against the US dollar, in and around 125. Citi said this morning. They see 1, further Bank of England repricing lower, 2, deteriorating UK growth prospects, and 3, the absence of meaningful fiscal support to cushion the blow from high energy prices, and they see more sterling weakness ahead. For the yield curve, here's another question. What on earth happens with this? I've been surprised by the breakout of 10-year yield more recently and the steepness that returned to 2s10s. 2s10s right now, 21, after briefly being in negative territory over the last couple of months. The team at Morgan Stanley say this: maintain 2s10s and 2s30s flatteners as the incoming inflation data and the Fed's desire for optionality will put upward pressure on front-end rates, while pension demand and rising global risk will keep long-end rates in a range. Jim, can I come to you on that? Is that the right way of thinking about this yield curve at the front end and the long end and the dynamics that influence each part?
I think it is. This is typically the way the yield curve does invert, is that the long end of the curve, because of concerns about something breaking and risk-off concerns, holds in, while short rates run up through it, otherwise known as a bear flattener. And I think that's what we're going to continue to see. That's what we had been seeing all the way up until the early part of April when the curve inverted. And I think we're going to continue to see more of that. In other words, if you're looking at which rate is going to go up more in yield from here, it's probably going to be the short rates that are going to go up more than the long rates. And that's how you're going to wind up getting a yield curve inversion. So that's historically the way it's done. And there's no reason to think that this one's going to be any different.
Gershon, final word here just on treasuries, and then we'll return in the next segment to talk about credit. But on the yield curve specifically, your thoughts?
Yeah, I broadly agree with Jim that I think we should expect flattening, even an inversion. But I'll tell you what I'm looking at. I'm looking at the volatility across the curve. You look at the longer end of the curve, right, which is much more market-based. We're in the 92nd percentile of volatility over the past 30 years. What that's telling us, and I think rightfully so, is we just don't know. And it starts with the Fed. The Fed, I think you asked earlier, I think that Chair Powell is going to preserve his optionality. He's going to be very clear that he's going to be able, he will go as fast as he needs to. And what that means is the long end's done a lot of the work of the Fed already. It remains to be seen what happens in the future. I think there's much less certainty. I do hope, however, John, we start talking about some of the valuations, particularly in the credit markets, because it's not all doom and gloom. There are some opportunities here.
That's why I teed it up, because I know you're thinking about buying maybe a little bit more. We'll talk about that in a moment. Gershon Diston founder Jim Bianco sticking with us, Equity Future respectively. Gershon Diston founder Jim Bianco back with us. Gershon, I promised you we'd get to this. there's a lot of stuff to worry about, but the price of the story has changed. And the price of the story has changed sufficiently enough for you that perhaps you like what you see. Can you walk us through it?
Well, I with the caveat that we don't know what's going to happen in the short run, we will still have more volatility, could be some more pain. Levels are starting to get pretty interesting. Think about this, John. You know, when investment grade corporate yields were around 2%, that wasn't very attractive to people. So they went and they kind of stretched for high dividend paying stocks. Today, you don't have to do that. The investment grade level is 4.6%. That's actually higher than high yield was just a few short months ago. And we don't have the same excesses in credit. We're only like really 2 years into from COVID, the COVID kind of sell-off. Companies haven't had the time to re-lever, to buy back shares, to make acquisitions, to ramp up their capital expenditures. So credit always protects better in the downturn. And given the uncertainty, I think this could be probably is a buying opportunity. No doubt, things feel bad. But you look at almost every time period where things felt bad, whether it was TMT in 2002, the global financial crisis in 2008, the European debt crisis in 2011, energy in 2016, COVID in 2020, and go on and on. It felt really bad at all those times, and those were all great buying opportunities.
Jim, are things uncomfortable enough to say, I'm so uncomfortable it's worth buying?
Well, they're a lot closer to that than they were. I agree with Gersten about 2 months ago or 3 months ago. And yeah, you're starting to get some real yields. I mean, if you want to go all the way to the end of the risk curve, triple Cs are now north of 10%. Yeah, it's a risky bet, triple Cs, but you're now getting 10% plus on those yields. So I think we are a lot closer to it being a buy than we were a couple of months ago. And yes, I agree with Gersten that, you know, the next couple of months, we don't know what's going to happen. But in the broader picture of things, when you start looking at yields like we've been seeing now, 4.5% on investment grade, up to 10 on triple Cs, you have to start looking for opportunities.
Gersten, can you clarify with a little bit more detail where you're looking to play offense then?
Look, I think very broadly, the dispersion is quite low. And what that's telling you is we don't expect a lot of winners and losers. We had a default cycle already. So you kind of want to be as broad-based as you can here.
I've had a lot of people say, go to cash, build out a cash position, just so you've got that optionality on dislocations. Gersten, how do you approach that story, just that cash position, to play that defense side?
Well, timing is everything, John. Yeah, if you were smart enough to go into cash a few months ago, kudos to you. Of course, there are a lot of people that were hiding in cash after COVID as markets started to run up. That's very, very hard to do. Look, we've been hearing for a long time that yields are very low. And, you know, let's wait for yields to go up. As if when yields actually go up, like we're seeing now, it's just going to happen in a vacuum. They're just going to go up, spreads are going to widen, and it's going to be a great buying opportunity. No, that only happens when you have stress. And we have stress now. You know, I can't think of a time in my career of 25 years where when markets felt really good, the fundamentals were really strong, and then it was an outsized buying opportunity. It's usually the other way around. And investors that go against the grain, and, you know, as long as they have more than like a 6-month time horizon, are likely going to be rewarded at these levels.
Gersten, can I just respond with just one question? And that's QT hasn't started yet. We've only seen one rate hike. There were people listening to this saying, Gersten, I'm with you, it feels uncomfortable, but I think it's going to get even worse. What do you say back to them?
I would never say that there aren't risks out there. I think certainly if inflation doesn't come down, the Fed's in the impossible position. I think Jim touched on it earlier. I think they're going to keep on going and not care about markets. So that is definitely a risk there. But you have to look at what's happened in markets already. You know, the Fed is clearly, we don't have to debate whether the Fed's behind the curve. They're behind the curve, right? They should have started hiking rates in retrospect probably 12 to 18 months ago. But the market's done a lot of the work for them, right? The long end of the curve, which is where a lot of rates get set, has kind of done that work already. Again, could it get worse? Sure, it can. There's always risks out there. But I'm a betting man. I play the odds, and I think the odds at these levels are pretty good.
Gersten, wonderful to get your view. As always, it's been too long, buddy. Gersten Distenfeld alongside Jim Bianco. Coming up, the morning calls and